Looking at a US dollar Swiss franc 60-minute chart, price has fallen. We are in this rally here, and price has like nudged up above these highs here at 31.20. And moving forward here, we see that on an intraday level, price has come up and has retested that high, and it has rejected it. And this is an overall retracement from this big swing, from this high, double top high. Price has come down. It is now retracing. And what we see here is we see that we've got this small term trend line. And the market has broken through the trend line, has come back to the last level of support here. And now, once it does that, we've established our level of support. So we have a potential head and shoulders scenario. And price is already back up to the 62% retracement level. And here's our left shoulder. It's ideal if we can get in that around that left shoulder area, but you can trade it somewhere between the 38 and the 62, or between the 38 and the 79. The difference is 30.89 and 31.12. So it's not a real big difference. Trading it anywhere in here is good. The higher the better. It could come to the 79% retracement, but if you trade it here at the 62, then that's good. It's 31.03 to 12. It's only 9 pips difference between here and here, and in fact your stop should go above here. So if you're at 03 and the high is 25, you've got 22 pips. You can have a 25 to 30 pip stop and hold it above this high right here. Now if you wanted to wait for confirmation, you can do so, as we're getting late in the session and the trade may not come to fruition until we get into the next day. Tough to say though. But as we get into this consolidation late in the day, let's see what time it is. Yeah, it's quite late in the day. So as we're in this consolidation late in the day, you're fairly safe trading if it comes back up here and tests it again, then, because you want to be on the positive side of the dealing spread as the market decides on a direction. So you want to trade it as close to this level as possible. You can take the chance that it will spike up here, but you should be pretty safe at the 62% retracement, like right around here, trading it as it's on upticks. Trade in the upticks. Okay. Now price during Asia starts to liquidate and starts to fall. We come down to the 127% extension, then to the 162%, not quite, 162% extension. We retrace to the base of the neckline. Retrace to the base of the neckline. Comes back down, pauses again at the lows. Another spike up to the neckline. You'd be able to see this. This is very interesting market action because this is quite a pullback to the neckline. But the idea is this, is that you want to take your first profit. If this is 31.03 and the base here, the base of the head and shoulders is 30.68, so say 30.70, you've got 30 pips and a little bit to take your first profit. You want to take your first profit, or say take 70% out here. Then if we get down to one of these extensions, you can take 20% out of the market here, and then leave 10% in and manage your stop accordingly. So if your stop starts here, after 70% gets taken out, you can maybe move your stop down a little bit. Then after price moves down here, what you'll do is this, is you'll take your Fibonacci, you'll trail behind the market, move your stop behind the 62% retracement, which is also, you're now, if the market comes all the way back up and stops you out, you're still in a profit position. But if price comes back up and tests the neckline, or even comes deeper all the way up to the 62% retracement, you're still safe. Then if it keeps going, you still have 10% in the market to last for as long as the market will permit, depending on how key this level is. Now let's watch. We started our trade at 130. We started our trade at 130. Let's say 130. I'm sorry, 130. 131. Say we started our trade at 131, and now price is at 130, so we're up 100 pips on the trade. Our stop is up here, staying beyond the range.